Welcome to Community Questions. Each month, we choose a category of our research, which might be macro or technical strategy or digital assets, policy. This month, we chose quantitative research. And for those who are unfamiliar with this category of our research, it is data that spans from well-structured, highly available information like price and volume to less structured data, such as social media posts and text documents. So there's a lot to unpack in this category of research. Before we start, if you're not part of the FSInsight community, check out the link in our description and you'll make sure to get notified of all the great information that we share with our community, feedback from our research team, and also you can vote on questions for next month's community questions. So without further ado, let's get started. We are here with our head of quantitative research, Adam Gould, to answer your questions. Hey, Adam. So our first question from the community is how to apply your factor strategy to someone's portfolio.
So that's a good question to start us off. So the factor strategy is designed to provide outperformance relative to the S&P 500. It can be added to a portfolio that has a risk profile similar to the overall equity market. And over time, the factor strategy should provide excess return at a similar level of risk to the market. Now, investors can allocate funds to the strategy's individual ETFs in the weights that we describe in our monthly update pieces. Since the factor strategy rebalances monthly and uses very liquid ETFs, it only incurs minimal transaction costs.
Thanks, Adam. So the next question applies to Mark Newton, who is our head of technical strategy here at FSInsight as well. And he reports on the daily what's going on in the markets and provides some technical analysis each day. So could you give us a little insight on how factor strategy can complement technical strategy?
So the dynamic factor strategy uses a systematic approach to identify the factors that are likely to outperform and underperform. It actually doesn't use any technical analysis in deriving its recommendations. Now, more generally, quant strategy can be used to complement other types of analysis like technical analysis or fundamental analysis. When you combine quant strategy with other market approaches like those, it typically generates superior returns. And one way to implement this combination of quant with either technical or fundamental analysis would be to combine the results of a quantitative stock ranking system with recommendations from either technical or fundamental or other types of analysis. So again, the best way to take advantage of quantitative stock selection strategies is by combining them with other methods of analysis.
Thanks, Adam. So the next question is kind of a poking holes in quantitative research. So what are some of the benefits of your factor strategy and quant overall? And maybe what are some blind spots or weaknesses to this type of research?
So these are important questions for quant research, or really any kind of research approach that you want to take. The most important benefit to the dynamic factor strategy, and really to any quant strategy in general, is that it takes emotion out of investing. A properly designed quantitative strategy, it won't panic when the market sells off, and it won't get a case of FOMO when the market rallies. So another benefit of quant research is that it provides us with generally accepted, well-known approaches to evaluate the performance of a strategy, quant strategy or otherwise. These approaches allow us to break down the performance of a strategy into its component drivers, like sectors or factors, and there's other types of drivers we have as well. And we can use those individual drivers to determine the contributions to the overall risk and return of the strategy. Now, the major weakness of quant research is that it relies on historical data. Now, one particular issue that quant researchers face is something called overfitting. Now, because quant strategies or any strategy developed from quant research is based on historical data and historical relationships, when those relationships change, and they often do in financial data time series, sometimes quant strategies can see periods of poor performance. So I like to say that no one's ever going to show you, including me, no one's ever going to show you a bad backtest. What this means is that when historical performance is shown for a strategy, it tends to look good. I mean, after all, if a strategy performs poorly in its history, it's typically not going to be marketed. Avoiding overfitting is one of, if not the most important challenge in quant research. Many techniques have been devised for dealing with overfitting, and with the increased use of alternative data and advanced machine learning techniques, avoiding overfitting when building strategies is more important than ever.
Thanks, Adam. So I'm going to ask one more question, if that's okay. This is just out of my personal curiosity. And then also, I think some people in our FSInsight community might be curious as well. But why quantitative research? What got you into this field?
What influenced me to focus on quant? So I've always had an interest in math and science growing up. My degree is in computer science, and I also majored in math. After working for a few years as a software engineer right out of school, I went to work for a large quantitative hedge fund where I was first exposed to quant research. I was really drawn to the systematic mathematical nature of it and how new strategies could be designed, built, and tested. I also like the fact that quant research is constantly evolving. There's constantly new data sources and new algorithms being revealed. So for me, it's a really interesting field.
Thank you, Adam, for your time today. And thank you for watching. And if you're not part of the FSInsight community, make sure to click the link in the description and join us.